Okay, well, last time we did the trial balance. We had all the account names put in there per the account ledger, whether they have a balance or not. We then add all the account balances, debit or credit, make sure they're on the appropriate side, and when we're all done, we add them up, and if they equal, we then double rule them. But since double ruling is hard to see in this in the Excel, I will just highlight it to a yellow color, or I could do a gray color for when it's printed out or whatever. But that just tells me that it's going to be, that it has been proven and ruled. So after that, then we did the adjustment for merchandise inventory. And what we did was we had the merchandise inventory start out at $254,244. It ended up, after they did the inventory and valued everything, their value for the final inventory as of December 31st was $239,354. We had to figure out what the difference was, and that's where this little worksheet comes together. We did these calculations, and since it was a higher debit went down to a lower debit, we have to credit it in order to get our account to go down. So we do a credit of merchandise inventory and a debit of income summary, since merchandise inventory does not have a directly related expense account. Okay, so today on chapter in 15.2, we're going to analyze the rest of the adjustments in our book here, or on our worksheet. And if you go to page 377, we have the work together that we're going to work on. And the accounting concept that we're using for all of this is the accounting period cycle. So we do this for every cycle, whatever we want to use for our fiscal period. You can use it, but the concept is the accounting period cycle. So let's go directly to page 377 and work together. We're given the physical count and values of those three accounts: supplies office, supplies store, and prepaid insurance, as they're listed in the book. And what I would suggest that you do is add them all onto the worksheet in the balance sheet column, but we're going to do the work together first. So looking at that, let's go ahead and do that together now. What is the balance of the office supplies? So it tells us our balance, and we use that at the beginning of the year. It's $6,091. And it gives us a current balance of $1,646. And what is the difference, we might ask? The difference ends up being, after you calculate it, $4,445. And since we go from a large debit to a lower debit, we have to credit it to bring it down. So with a debit and a credit, we have to have a debit and a credit. Debit's always listed first. Since we have to credit supplies office, for $4,445, we have to do it directly. Since we have a related expense account, which is supplies expense, office, and that would be debited $445.50. Okay, so that would be our entry. We'll go do that in our journal here when we get done. This first one was journal entry A, so we can label that A. We'll do B for this one. Our next one's going to be C. So with this one, what of our beginning balance? Our beginning balance is $6,516, and our ending balance per the book was $2,838 and no cents. So our difference ends up being $3,678. And since we go from a large debit to a lower debit, we have to credit the balance. And since we now need a debit and a credit, and here we have to credit the supply store, and then we have a related expense account, which is supplies expense, store, and that is $36.78 and $3,678. Okay, now we have to also do the prepaid insurance, and that's going to be our D entry. So our beginning balance for our prepaid insurance was $5,540, $5,540. Our ending balance is $2,540, which is $2,540. Our difference is an easy $3,000, and we're going to have to credit that to lower the debit. From a higher debit to a lower debit, we have to credit the account. So with a debit and a credit, we're going to credit prepaid insurance to lower the debit balance, and we're going to debit insurance expense since it is a directly related expense account. And they both get the $3,000 in the amount. Debit for the expense and credit for the prepaid insurance. Okay, now we're going to go through and actually do the entries using the first one for B. Which now I will go over here and we'll go B, and at the top we have to credit this amount for $4,445. Okay, and then we have to go down to the supplies expense store, and we put the same amount in there. Oh, wrong column. Better put it in the right column. Otherwise it'll really mess this up. And this is B. Okay, now we go to the next one, which is right over here, C. Supplies office store, or supplies store. We got C, and that is a total of $36.78. Then I can go down $36.78 for the supplies expense store, and that is C. Okay. Okay, now we're going to do the last entry, which is prepaid insurance. And that amount isn't even $3,000. and then I go to the insurance expense, which is $3,000, and I got D there. Okay, now what we have to do after we've done all of our adjustments, we have to go through and add them up. So I can do with Excel, I can do an easy formula, do a sum all, make sure I get the entire column, and my two numbers balance. So then I am good, and I can now highlight my numbers since they balance. Okay, now we're all done with this part. That's all of our adjustments. In the future you will have more adjustments to do, but this is just, everything's basically the same. If you have a matching expense account, you put it in it. If you don't have a matching expense account, you put it in the income summary. Now just remember that all of the all the accounts down here, all of these are all temporary accounts that will be closed out at the end of the period. So these are all temporary accounts. And I'll talk to you later on the next unit.